Over these past 2 years, the team here at Kino has worked to be one of the best personal computer companies around. This presentation will cover how Kino was able to establish itself competitively through market focus, sales, marketing, and finances. Then we will take a look at how Kino stands in terms of strengths and weaknesses through a SWOT analysis. The company has continued to grow through lessons learned, so we will be using them going forward to continue growing and expanding. By the end of the 8th quarter, Kino was ranked second in every aspect of the balance card. Ever since the beginning, Kino has continued to grow quarter after quarter. Our consistent strength has been in marketing effectiveness, but throughout the years we were able to grow every area into a competitive advantage, providing a stable foundation to grow further into the future. Throughout these 2 years, Kino continued to focus on 2 primary markets, traveler and workhorse. We didn't invest in new markets until we were sure we could without neglecting our target markets. Kino applied a market penetration pricing strategy by offering 2 great brands at a lower price than its competitors in order to capture market shares. Our percentage of market share increased in every quarter, going over 30% for our primary market. Later, we invested in Cost Cutter because we saw a lack of competition to gain a lot of customers, and operational expenses for building a new computer was relatively low. When we entered, our biggest competitor held 47% market share, but thanks to our pricing strategy, we immediately reduced their shares by 15%, capturing 39% of the Cost Cutter market. To enter Innovator, we began selling our existing products to introduce ourselves and the services Kino could provide. Therefore, when we did have a product for them, they already knew we were a company they could trust. Kino built a product for them in the last quarter when resources were available to build a fantastic product. Over the life of the company, we have maintained about a 20% overall market share. Our selling strategy started by opening offices in America and APAC. We were late to go into EMEA, but that allowed us to save money for R&D, advertising, and a solid sales force in both America and APAC, which happened to be our strongest markets. We made sure to balance small and large offices in each region in order to gain a strong market share. In order to provide a good basis for sales, Kino invested in a strong, well-trained sales force. We increased our sales force and support every quarter in order to gain more customers and offer them ongoing service. These last couple of quarters, corporate offered incentives such as gifts and vacations to our sales force to assist improved sales in our primary markets. To reach all of our customers, we provided a good mix of regional and local ads, but not too much to drive up overhead costs. We mainly focused on providing the best brand we could sell by creating quality products that reached to the top of the brand judgment ranking quarter after quarter. Our main 3 focus brands were almost always number 1 or 2. From those key features, we created top-ranking ads to attract all of our customers. The main driver for our growing balance card was due to our intelligent financial planning. Kino began financially conservative, but as our market basis grew, we invested in opportunities to grow our business more. A big driver was the research and development costs that enabled us to provide our customers with the quality brand they expected and helped us maintain a high ranking in the brand judgment. Kino also invested in maintaining a great sales force and expanding its business by opening up additional sales offices and the forces to fill them. Finally, we consistently increased our marketing throughout the quarters to expand our market base. Despite all the investing we did, Kino made sure to have money on hand to protect us from any unforeseen problems. We even offered rebates in the quarters that we knew would be slow in order to encourage customers to buy now instead of to wait. As every great business realizes, Kino has both strengths to utilize and weaknesses to overcome. Kino's ability to be flexible and perceive what customers want has proved to be a great success with these strong brands. But moving forward, we need to be able to assume a bit more risk in spending in order to grow quicker. When we're looking at the current market environment, Kino has some great opportunities to expand into new markets. We can do this through additional R&D or even acquiring capable existing companies. The company also has to be cognizant of our competitors and their impact on our business, especially due to technology or their influences on price. Kino made sure to evaluate changes in the marketplace and incorporate lessons learned as the game was going on, which helped drive our cumulative balance card rank up to number 2 in all areas compared to our customers. Oh, sorry, our competitors. Some of our successful strategies we implemented along the way included a quality brand no matter which market, setting competitive prices that were high enough to offer us margins to draw a profit from, and creating ads that appealed not only to the product app as itself, but also the advantages our products would bring to customers. Kino was smart with its money, being financially responsible for future endeavors, and then intelligently investing it to grow the business in all areas. There are some improvements though. Improvements Kino can continue to make would be expanding more quickly into other locations while we have the R&D advantages before the other businesses get there, and to increase our sales force more aggressively to bring those sales in. As Kino moves forward, we want to expand the company more globally and utilize regions such as EMEA that have potential for growth. In addition, we plan to diversify our product lines. We already have our foot into the innovator market, and we can evaluate the feasibility of acquiring other companies who can provide influence and improve our position. Finally, our goal is to increase our sales by at least 20%. Kino plans to increase its sales force to be more customer-focused and competitive. We will also begin expanding our marketing strategy to include additional media types. That way we can reach a broader audience. Kino has established itself as a great brand, and it's set itself up to continue to grow as we foster our competitive advantages. If you have any questions at this time, please let me know. Thank you for your time.